Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. We're going to sneak in episode number 4. We've been very, very efficient today. So I want to talk about Ray Dalio pivoting on his notion that cash is trash. Apparently, when the 10-year Treasury gets to 4%, he has a change of heart. You and I have been talking about raising cash for 9 to 12 months. You brought it to the channel, which I appreciate. I want to talk about raising cash today, kind of on the cusp of the bad times. And then more importantly, I want to kind of play out the next 2 years and how would people use that? What are some other things they should do? So talk about cash is trash or not.
Yeah, so he's right on both accounts, and this is why. So when he says cash is trash, you need to, again, qualify the information. Who's speaking and why, and what's he talking about? So he is a capital allocator. He is the largest hedge fund in the world, so he has to move cash. He has to move capital in and out of markets, in and out of assets in order to earn yield. That's what he does. That's how he makes his living, and that's what he has to do. So he's coming from that perspective. So in a risk-on environment, cash is trash. That means you should be in risk assets that are earning a higher yield than the benchmarks. So we were in a risk on environment for the last 2 years specifically, but prior to that, since 0809, because of the easy financial conditions, easing of financial conditions, Fed driven, Fed put, all that kind of stuff. Buy the dip because the Fed's going to rescue the markets. They're not going to come in and let the markets go down. That's changed. So now it's risk off. You're getting a higher yield in bonds. So there's no point in taking risk when you can get 4% yield in treasuries. The Fed is tightening financial conditions. The Fed has sent a clear message. We're not going to prop the markets up anymore. Now, the Fed doesn't have any credibility right now because they've changed and pivoted every single time in the past. But right now, they're saying we're never going to let the Fed benchmark go below inflation. We're going to keep it 100 basis points above inflation. We are not going to rescue the markets. We're going to let the dust settle where it may. Now, what they haven't said is they're not going to go in and do things in certain areas of the financial system if and when that happens, like the Bank of England did in with pension funds and stuff, or with corporations, or things like that. They might bail out certain industries, but what they said was we're not bailing out the markets as a whole. Markets are still not fully believing the Fed yet, and until we get there, we're not going to know. Till the market crashes like it did in 2020, like it did in 09. We're not going to know whether the Fed's going to do something or not. Now, what the messaging is unless there's an underlying, like a banking issue or crisis or something like that in the United States, the Fed's not coming to the rescue. They're not going to come to the rescue of the markets just because their markets are going down. That's what they want, or the housing market. However, they're not selling MBS yet because they know that'll destroy the housing market. So that's risk on, risk off. Cash is king, cash is trash, and cash is king when you're in an environment like this where there's opportunities to earn yield in a risk-off environment.
Oh, I just love how you put that together and you tie that out for everyone. And I think you're absolutely right. Cash is trash as a capital allocator when cash is essentially zero and being lost to inflation. You're right. He is right. But now we're in a different environment, risk off, and 10-year treasuries 4%. I think 1 year is like 4.3 or something. So I think you're absolutely right. Times are different, and Ray Dalio is smart enough to admit, hey, times are different. So shout out to him. I want to talk about average investors. You and I, folks that follow us, right? Let's pretend for a minute that people following us did what we talked about. They raised cash, they've been saving, needs versus wants, and they're excited about what's coming. When you have cash and you've put it, you've secured it, I don't want people to be in a rush to deploy it, right? Cash is that safety net. It is that cash will be an asset for you to actually perhaps go get terms because of your strength with a cash position. I think what's coming is an environment, and you've taught me this in businesses, go get terms, go learn terms, go get seller financing, go find those must sell assets and use terms to your advantage, and then let your cash stay there and be that asset. But basically, don't be in a rush to deploy it. Is that fair, or am I off?
Yeah, a lot of people feel like, oh man, I've got cash and I'm losing, money because of inflation and this, that, and the other. And you're better off letting inflation eat you a little bit than you are doing a deal and losing it or throwing it in the markets. If you're a retail investor in the markets, so if you 401k, pension fund, whatever it is, retail investor in the markets, this is a very difficult, dangerous, tricky time to be in and out of the markets. You got to really know what you're doing. You got to really be on it. The market isn't, we're in a bear market, and it can go down a lot longer, a lot faster than you think, and vice versa, it can go the other way. This is a buy the dip, sell the rip. The problem is, again, the Fed conditioned retail investors to buy the dip. We're going to be here. We're going to prop the markets up. So that conditioning is still there. The retail investor, the 401k, IRA, those accounts have been the last sellers, and they're starting to sell. We're starting to see some of that now because people are back to even and are like, you know what, I'm going to get out of here now before it goes down any further. So then you can buy back in lower when the narrative changes. So this is not the time to be in a rush. This is the time to be patient. Don't worry about your cash. At the end of the day, inflation's not going to break you. The markets are going to break you if you don't know what you're doing and you're not in a position to pay attention, because there is so much systemic risk out there. You don't know what company is going to go away and be gone overnight. Companies go bankrupt in these environments and your stock gets wiped out. Companies get, bailed out and wipes out, and equity investors. I mean, all kinds of things can happen. So, understand that. And then on the terms, people that are locked into their mortgages and things like that, there's probably going to be some subject to opportunities and term opportunities where you can lease option a property, take over a property, a lot of different ways to get somebody out of their property where you can take advantage of the low rate that they're paying. Just like in commercial right now, all of the assumable mortgages that were put in place the last 2 or 3 years, man, those are hot commodities right now in this rate environment. So, a lot of opportunities out there. And in businesses, a lot of business owners, are retiring, aging out. There's no buyers at today's interest rates. Equity multiples have changed. So they're going to be more amped and agreeable to terms than they were, last couple of years.
Yeah. So the last kind of comment is, if somebody came to you and maybe one of your investors or somebody on the channel and basically said, hey, should I keep saving, or is it time to put money to work? Is it time to buy the dip? Would you tell someone to stop saving today, or what would you say?
No, I mean, this is the time to build cash and be ready to deploy, because we haven't reached the bottom yet. We haven't seen the end of this. We don't know where it's going. This is not the time to be deploying cash in markets. Now, real estate too. Real estate's correcting, so you got to really understand your market, really know where it's going, and understand what's your goal with that property. If you're selling on speculation, this is not the time to be deploying capital. If you're buying income and the deal works with today's interest rates, and you're totally fine. Keep going, keep rolling, but just understand that the values have changed, and you need to be prepared. Whatever you buy today is going to be worth less tomorrow. So you want to lead the market down, and buy lower than you sold yesterday versus leading the market up, selling for more than you bought yesterday. So if the deal works and it's an income property, then you're fine. But if you're speculating it's going to be worth more in the short term, I wouldn't take that risk right now.
Yeah. I guess one more question I've always wanted to ask you that just popped in my head again is, what do you think about adjustable rate mortgages, specifically residential? Would you tell someone to bet on lower rates in 5 years and go get an ARM? Or are you a 30-year money guy? Or, let's just pretend it's a long-term hold. It's not a flip. It's not a burr, none of that stuff. Hey, I'm buying an income property. Should I get a 30-year mortgage, or should I bet on the Fed lowering rates sometime in the next 5 years? Any thoughts on that?
So risk reward right now, you got to think about how high could rates go from here. So you have less risk to the upside than you do to the downside. So this is a great time for interest only loans for 3 to 5 years, because you have to think, if rates go up, well, they're not going to go up but so far between now and another 3 or 4 years. They just can't, right? Or who knows, maybe they can, but we'll see. So if we get to 10%, if you're talking about mortgage rates, that would be extraordinary over the next few years. Is that possible? Yes. But it's more likely that you'll see rates hold or drop in the next 3 to 5 years than go up. But I could be dead wrong about that, could be totally wrong, but you have, less risk in that scenario by having cheaper rates today, thinking they're going to go up in another year or two, than you do thinking they're going to go down, anytime real soon.
What I would tell someone is run the numbers at the highest interest rate. And if they work and you want to gamble, then that's on you. But don't be the people like 06, 07, 08 that were running numbers on teaser rates and then they blow up when they reset. Don't be that person, for sure. So don't do a skinny deal in an ARM that makes it look okay. Run the numbers with fixed rate debt, and then if you want to gamble, that's on you. Is kind of what I tell people. What do you think?
Yeah, exactly. And for people watching, there was a great interview on CNBC with Don Peebles. He's a successful real estate developer in DC. So if you go to CNBC and you go to the real estate page, he did an interview and he talked about that exact thing. He said, man, when I bought my first properties and rates were in the 9-10% range, and that was a good rate. Same here. So he, says there is a chance you could see, double digit rates and, those possibilities. I mean, rates, back in the 70s hit almost what, 20%.
Yeah,
So
20.
yeah. So the question is, how high could they go now? And is it really bad where we're at now? So it's all relative, right? So that's a good interview for anybody to watch. He talks a lot about where we're at in the cycle and, what he's experienced and where rates could go.
Yeah. And Don Peoples wrote a book. I remember reading his book. This is probably 15 years ago, but he does have, I don't know if it's still in print. It's him standing in front of a Bugatti. It's blue, as I recall. That's the book I remember.
Yeah. And he's also pivoted. So his big thing is, they were building, buildings, condos, multifamily for sale product. He converted them all for rent product.
Oh, he
And he's
did.
got some really good comments on the multifamily rental market and where rents are to income and certain markets that are under pressure and things like that. It's a really good interview.
I will go look it up right now. Greg, where can people find you?
GregDickerson.com.
Thank you so much.